Hey everybody, Dieter Scherer here from RealizeYourRetirement.com. With all of the worry about the fiscal cliff and how it might affect you, I think it's important to have a solid understanding of how our tax system works. I'm sure a lot of you have heard that the U.S. uses a progressive tax system, where people with higher incomes are taxed at higher rates. Sometimes people take this to mean that if you're married filing jointly and make $100,000 each year and you're in the 25% marginal tax bracket, that you would pay 25% of your income in taxes. But a marginal tax rate shouldn't be thought of as a flat tax rate for all individuals in that bracket. It's actually the amount of tax that the government will levy on your next dollar of income. So, if you're married filing jointly and together you make $100,000 each year, you're in the 25% tax bracket. And if you get a $1 raise, 25 cents of that last dollar will go to Uncle Sam, and 75 cents will go into your pocket. But your average tax rate is actually lower than that, because you would have paid 10% on your income within the 10% tax bracket and 15% on your income within the 15% tax bracket. As you can see, this table shows the tax rate for each tax bracket and the filing status of the taxpayer. As you increase the income of a taxpayer, the tax rate increases an additional amount for each additional dollar of income they earn. To illustrate this more clearly, I'll use an example. Imagine you're a single taxpayer with an income of $200,000. Because you have an income between $178,000 and $388,000, you fall within the 33% marginal tax bracket for the 2012 tax brackets. I'm going to take you through the calculation of your tax liability, and when we're done, I hope you have a better understanding of the difference between a marginal and average tax rate. So for the first $8,700 of your income, you're going to be taxed at a rate of 10%. So we multiply 8,700 by 10% to get a tax liability of $870. Then we move on to the next tax bracket, which is a tax rate of 15% of your income. That falls between $8,701 and $35,350, which amounts to $26,650. So we multiply your next $26,650 by 15% and get $3,997 as a tax liability for the 15% tax bracket. We'll keep doing this for each tax bracket as we go along. So we multiply the next $50,300 that falls in the 25% tax bracket by 25% to get a tax liability of $12,575 for that tax bracket. Your next $93,000 is multiplied by 28% to get a tax liability of $26,040. And finally, we move on to your highest marginal tax bracket of 33% and multiply $21,000 over your income, which is found by subtracting the bottom of the tax bracket of $178,651 from your income of $200,000. And we multiply that by 33% to get a tax liability of $7,045 for that bracket. If you add all of these up, you get a total tax liability of $50,527 for an income of $200,000. Now, to find your average tax rate, you divide your total tax liability by your total income, which in this case comes to an average tax rate of 25%. Which is much lower than the marginal tax of 33% on your next dollar of income. I hope this clears up any misconceptions you may have had about how a marginal tax rate works versus how an average tax rate works. Thanks for watching, and I'll see you next time.